Align Technology recently announced earnings for their second quarter of 2023. We can see the stock is up 22% over the last year, while the rest of the market is only up 8%. And on top of that, when Align Technology announced their recent earnings for the second quarter, their stock jumped from $325 per share all the way up to about almost $400 per share. So a massive uptick in the stock price for Align Technology. And so in this video, we're going to look into some of the recent news that came out surrounding Align Technology. We're going to look at their financial statements, and then we're going to use a discounted cash flow model and also figure out the weighted average cost of capital for Align Technology to figure out their intrinsic value per share so we can know what a good price would be to buy into this stock from a value investing perspective. So right here, there's a quick little article titled Align Technology up 17.69% to $399 per share after earnings beat. They point out that earnings came in at $2.22 per share, which is 9% higher than estimates $2.03 per share, and it's 11% higher than the $2 per share they reported in the second quarter of 2022. Revenues were upbeat at $1 billion. That's an increase of 3.35% in revenues from the second quarter of 2022. The stock was up almost 18% to $400 per share after the report, and the firm's lower revenue growth to earnings growth signals that the firm has been able to reduce costs and improve their profit margins overall. So all in all, pretty good news for Align Technology. Right here, we can see in their financial statements, we're going to look at their income statement, balance sheet, and cash flow statement. For their income statement, net revenue is up from $969 million to $1 billion, an increase of 3.4% year over year. But unfortunately, net income is down from $112 million to $111 million, down 1% year over year. So unfortunately, even though they were able to increase their revenue, they weren't really able to increase their bottom line net income as quickly as their revenues. Then for page 5, we can see this is their balance sheet comparing total assets for December 2022 to June 2023. During that period, total assets are up from $5.9 billion to $6.1 billion, and we can see they have $3.6 billion of total equity, $2.5 billion of total liabilities, and then we can see retained earnings is down from $2.5 billion to $2.4 billion year over year because of the fact that they probably redistributed money to shareholders, reinvested back in the company, and they weren't able to replenish the outputs from their retained earnings with net income as it decreased year over year. Lastly, for their cash flow statement, we can see operating cash flow for the first half of 2023 compared to 2022 is up from $157 million to $451 million. And their cash from financing activities shows that they repurchased common stock of $292 million in the first half of 2023, which is up from $275 million in the first half of 2022. So they're prioritizing returning value back to shareholders a lot more this year than they were last year. And on top of that, they are a lot more cash flow positive this year than they were last year. So those are definitely two good signs for Align Technology. Right here, we can see this is the discounted cash flow model to figure out the intrinsic value per share for the company. I'm using a negative growth rate, unfortunately, for Align Technology of negative 3.5%. And I got that from figuring out their historical growth rate for their cash flows. For 2018, beginning free cash flow year, they had $330 million of free cash flow. But in 2022, they had free cash flow of $280 million over a 5-year time period. That means that their CAG, their compounded annual growth rate, basically came out to negative 3.53%. That's how I got this growth rate for this discounted cash flow model. The weighted average cost of capital, which I'm using to calculate the discount rate to discount their future cash flows to the present value of those future cash flows, is 8.34%. I got that from using this weighted average cost of capital calculation right here. We saw from their balance sheet that most of their business is financed by equity. They had $3.6 billion of equity and $2.35 billion of liabilities. They didn't really have cost of debt in their most recent full year, 2022. They basically had no interest rate for their debt. Tax rate was 39.6% effective tax rate for 2022. 10-year treasury yield at the moment is 4.10%. Align Technology's beta is 1.64, so basically they're a little bit more volatile than the rest of the stock market. Average stock market return is 10% per year. And so with this information, I was able to calculate Align Technology's cost of equity, which is their risk-free or the market's risk-free return added to their beta multiplied by the average stock market return minus the risk-free return, the 10-year treasury yield. That gave me 13.78% for their cost of equity. Equity proportion makes up 60% of their balance sheet compared to 40% for their debt proportion. To calculate their weighted average cost of capital, I just multiplied their equity proportion by their cost of equity, added that to the debt proportion multiplied by the cost of debt, and then multiplied that by the tax shield, which is 1 minus the tax rate, and that gave me 8.34% as the amount for their weighted average cost of capital right here. Terminal value 10. Free cash flow for their most recent full year, as we saw down here, was $276 million. They have a net cash position on their balance sheet after subtracting debt of $900 million, and they have 76 million shares outstanding. Putting their intrinsic value per share at $46 per share, that means that at the moment they are definitely not trading below intrinsic value per share based on those growth rate estimates. You want to buy them at a much cheaper share price than the one they are currently trading at. But obviously, I encourage everybody to do their own due diligence when using a model like this. There are a lot of assumptions: weighted average cost of capital, growth rates, terminal value. So do your own due diligence, and if you disagree with these numbers, then let me know in the comment section down below why, and let me know what your numbers are. I'd love to compare them and talk about it. So right here we can see the competitor/industry analysis comparing Align Technology to some of their competitors, Smile Direct Club and Henry Schein. We can see that gross profit margin, Align Technology has the highest at 70%. They also have the highest net profit margin at 9.68%. One of their main competitors, Smile Direct Club, isn't even profitable, so that's a good sign for Align Technology. For return on assets, Henry Schein and Align are basically neck and neck, and then for PE ratio, Align has the highest PE ratio, trading at 88 times earnings currently at the moment, and none of the companies pay a dividend to their shareholders. So based on this analysis, it looks like you'd probably want to give it to Align Technology. They're doing better from a profit margin perspective than Smile Direct Club and Henry Schein. But to be honest, none of these companies are really putting up numbers that are that impressive. But if you wanted to compare them against each other, you'd want to give it to Align Technology. Lastly, I wanted to compare Align to some of the other companies we've looked at in past videos. In terms of intrinsic value to share price, we saw they're definitely not trading below intrinsic value per share, so they don't make it onto this table. So far, Google, Alibaba, Albertsons, and Etsy are the only companies we've looked at that are trading below intrinsic value per share. We can see that for growth rate, they had a negative growth rate, not good enough to get on the table. Sushi has the highest at 37%. But for gross profitability, they do have a 70% gross profit margin that puts them in 5th place on this table. Very competitive profit margin. Adobe has the number 1 spot at 86%. For net profit margin, they weren't competitive. They only had a net profit margin of 9%. Not good enough to get them onto the net profit table. Oxy has the highest at 36%. We can see that for dividend yield, Align Technology doesn't pay a dividend, so they don't make it onto this table either. Intel has the highest at 5.52%. And then for second quarter year-over-year revenue and earnings growth, revenue growth for Align Technology, as we saw from their financial statements, was only 3%, and they actually decreased for their net income year-over-year by 1%. So not good enough to get them onto either table. 47% for Tesla's revenue growth was the highest for the second quarter year-over-year. And then for Intel, 400% increase in their year-over-year second quarter earnings growth was the highest for this table. Lastly, for stock performance over the last 5 years, Align Technology is basically neck and neck with where they were 5 years ago. They basically haven't really improved or declined over the last 5 years, so definitely not good enough to get them onto this table. Tesla has the number 1 spot at a 1,144% return over the last 5 years. So based on this, it looks like Align Technology is not really that competitive in terms of stock price, net profit, year-over-year growth rate, or dividend yield, or share price to intrinsic value, but they do have a very competitive gross profit margin relative to the other companies that we've looked at. We could see from the discounted cash flow model that they are currently definitely not trading below intrinsic value per share, and compared to the other competitors, their main competitors here, like Smile Direct Club, they're definitely doing better, but these profit margins aren't really that impressive. But in comparison to their competitors, if you wanted to give it to somebody, you could give it to Align Technology. So let me know in the comment section down below what you guys think of Align Technology. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.